on now. They respect us cause we on now. Money up, run the whole town, don't we? This power money can't slow down. Money won't slow down. Ooh, we do it live. How we got on top. How we got on.
Man, while we're driving, I had 2 international calls because I'm closing 2 to 4 international deals at the exact same time. So it's been a very busy day. But the most joyful part of this is I got to include my nephew in this entire journey. He flew for the first time on an airplane from Dallas to Jackson. He enjoyed that. And then, of course, we're flying back tomorrow. But to be able to walk him through the process of house 1, house 2, him hearing those phone calls I was actually having, meeting with the realtor, sitting in those meetings with the realtor and the mayor of Starkville as we negotiated that deal, passing on that knowledge to the next generation. That was the most joyful part of this whole process. Stay blessed, guys, and holla at your pot.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partners, Cliff, and they're back in the saddle again for another edition of The Investor's Edge on Friday. At this time, guys, at 3 p.m. I like 3 p.m., Cliff, don't you, man? A little bit earlier.
I think that works out well.
It works out well. We get in, get out, which is good, guys. But you know, we had to ask the question, Cliff, did we get that bag?
Yeah, got the bag this week.
We got that bag, yeah. We got the bag as well, guys, which is good, man. You know how we do it every single time, guys. Cliff, we haven't did a current market analysis in a long time. Folk be getting mad. We get mad, bro. So I'm like, all right, man. I said, guys, we'll give you the current market analysis. We got it, guys. But guys, if you could, guys, do us a favor, like, share, and subscribe real quickly, guys. There's a little bit of a bell on there, guys. Do us a favor, go ahead and click on that bell. And so when me and Cliff come live, you can kick with us live real fast, guys. All right. Well, Cliff, let's dive into it, man. Yo, man, boots on the ground, guys. This is a licensed appraiser that's on the screen. Cliff, man, let us know what's going on in the marketplace, man. What you see in the marketplace? What's going down, bro?
Man, not much change from last week. Starting to see the market still settle in. It's still a buyer's market, especially down around Dallas-Fort Worth. And we're probably going to keep seeing that for a while, because interest rates are not going down, they're going up. You probably can expect that you're going to be able to get a good deal for the next probably year to 2 years. And we're still waiting to hear from the Fed to see what direction they're going to go, because the new Fed president is not providing guidance, which is different from the last Fed president. So we're going to see where it goes. But right now, the market is staying the same. It's lukewarm. If you're looking to buy a house, now is probably a good time to do it. Hoping to be able to refinance later, but just negotiate a deal. And I'm gonna say it's gonna be like that for a little while.
I agree, guys. It is, the rates are not coming down. It's not gonna happen, guys. It's gonna be stuck here for a long period of time. It realistically is. So if you're waiting for the rates to move, guys, you're gonna be ready for the next 2 or 3 years. Easy. It's gonna bleed into the next administration, whether it be Democrat or Republican. And I believe even there, it's not going to move. I think for the next 3 to 5 years, you're going to get some steady Eddie type of interest rates, because they're not going to stop printing. 6.5% is the new 3%. It is. So, I mean, if you want to buy a property, guys, retail wise for your homestead, be prepared to pay. Be prepared to pay 6.5% and above. right? And it's strange how when it comes to these type of loans, man, FHA, well, not FHA, but more conventional loans, you pay a higher interest rate with more money put down. That's strange, but that's because the government actually insures FHA loans. Am I right, Cliff? Am I wrong, Big Dog?
Exactly. Yeah, government's going. That's what they're doing, right? Federal Housing Administration is going to back the loan, basically insure the loan, so the banks have no liability.
Yeah, it's real simple, guys. It's not hard, guys. It's not hard at all. It's not hard. But guys, that's the current market analysis, guys. Nothing is changing, guys. Nothing at all. I don't see nothing change. They just is what it is. But let's dive into our topics today, guys, real quickly, man. Today, guys, we're talking about this here. Man, we're talking about, man, the crash banks are hiding. Is there a shadow inventory going on behind the scenes that the banks are not telling us about? We got to gonna talk about this real quick. He's going to talk about the residential and the commercial multifamily. Number two, we're going to reconvene our discussion on the 50-year mortgage. Yeah, it ain't back. It's been here, guys, but it's getting talked about a little bit more. Okay, specifically in this time frame. And lastly, hey, the richest man in the world, Elon Musk, Cliff, he founded his own bank, Big Dog, called X Money. It's a digital bank. We're gonna talk about that, man, and see how this is going to really affect people. All right, so that's what's going on. Let's go to our first topic real quickly, guys. Hey, not that one. Nope, that's not what I wanted. Boom, here we go. Man, the crash that banks are hiding, what the housing headlines aren't telling you. Cliff, let's kind of dispel some of this myth. Is there such a thing as a shadow inventory?
Oh yeah. So banks don't want to put all the properties that they have in their inventory on the market at once. They typically wait times to go put it out, and that's sometimes to renovate them, sometimes to sell them in portfolios or pools, so that they're behind the scenes. And they sell them to hedge funds and other banks and other stuff like that. So yeah, absolutely. The banks, a lot of them, they have inventory that's not on the open market.
And when do banks normally like to keep that inventory, the shadow inventory?
I mean, normally they want to keep them when the market's not good. You know, when you're starting to see a lot of pullback, they'll hold because they don't want to. They hurt themselves by putting too many houses out at once.
Agree.
Because it lowers the value of the properties they have up for sale now.
Correct. I agree, guys. Banks right now, guys, what's going on with them is there is a shadow inventory out there in both. And I think the inventory is a lot more higher in the commercial arena versus the residential arena. And let's bring in one of the GOATs, guys, in my opinion. His name is Ben Mala. Ben Mala is, man, when I say he's a GOAT, guys, he is a GOAT. And Cliff was the one who actually kind of put me on game with who this guy was. And this guy buys everything. Am I right, Cliff? Am I wrong?
Oh, yeah, that's man. Ben Mala, man, he entertaining as hell.
Yeah.
He got a big mouth, likes to talk, but he knows business. He started with nothing, and he grew it to $100 million plus real estate empire. So you know what he's talking about.
So when he talks, guys, damn it, we listen. Let's see what he has to say about this shadow inventory. Let's go.
We sold quite a bit of real estate. Maybe I shouldn't have. Maybe I shouldn't have sold.
What makes you say that?
I thought that the market was going to turn and the banks are keeping it from turning. That's what's going on.
What are they doing?
I mean, listen, I'm out there on the street. I'm dealing with brokers. I'm at properties. I know. I really know. I'm not just talking out of my like a lot of people. I'm out there doing it. And all the big shots and all the people that thought they were so brilliant that overpaid during COVID in 20, 21, 22, 23, they're getting screwed now because they didn't know what they were doing. Okay? Typically, you know, these types of properties don't have long-term financing on them. So they all locked in at their little 3% rate. They locked it in for 5 years. And now the rate's double. They got to refinance. They got to pay the bank back. They're not going to cash flow. What does that mean? that means that the loans that the bank made are no longer at the same value they were when they made the loan. Why? Because the property can't cash flow double interest rate. It's simple. And listen, I deal with sellers every day that are just ready to throw the keys and walk away from millions of dollars in equity investment that they had. And a lot of them pool people together, okay, with your syndicates and raising money and all that. So, a lot of people are going to lose their shirt.
Yeah.
But the banks loan too much money. Not only the buyer, the own people that bought property are going to lose, the banks have to lose. Why? Because the property ain't worth it. And a lot of these places, these people shouldn't have bought real estate to begin with. Because when I go out there, because they were bleeding, they're not operating properly. So therefore, the property deteriorates. It's not being managed properly because they don't have the experience. So they hired a management company, and the management company don't care. They have no skin in the game. So there's a lot of distress out there right now. I've looked at thousands of apartments and multifamily, and there's a ton of distress out there.
So what are the banks doing right now to prevent the collapse from happening then?
They're on the fence. They need to get off the fence and realize this loan is not worth what we loaned on it. But they don't want to do that. They don't want to admit it. They don't want to realize it. They've all been praying and delaying. Praying rates are going to come down. Okay, keep delaying. But now it's at the point where the sellers or the owners have let the properties go because they don't really know what they're doing.
So they're just letting it go to the bank.
Interest rates have now, what happens is when your time runs out on a loan, you have a fixed rate for so many years. All right, well, when the fixed rate period is up, it goes to today's rate. They can't handle that. Okay, so the banks are just trying to work with them. But there's nothing to work with.
Couldn't they just delay a little bit?
Delay. They've been delaying. They've been delaying for years now.
But it sounds like they're still delaying. It sounds like they're just delaying another 6 months, another year.
A lot of sellers aren't even paying now. They just threw their hands up. Because a lot of them, they bought these properties. They realize that they're not equipped to rehab it. They don't do a proper budget. They don't know what they're doing. Too many people have gotten into real estate now that don't know what they're doing. And then what they're doing is they're pooling a bunch of money together, okay, which is even worse because now you got, all these investors and 10 different owners, and it's a mess. So there's a lot of real estate in the market right now that's distressed. And the sellers are ready to just walk away. Hopefully, a lot of them are personally guaranteed. That's not good. The ones that are not personally guaranteed, they'll just walk away. But the banks have to get it in their head, get this off our books. But they don't want to do that. You know why? Because if it gets out, then the value of the stock will go down in that bank. Why? Because the bank is only worth the value of the loans.
So you're saying a lot of these properties are completely underwater. It's not like they just wiped out the equity. They owe more.
They're all over the board. I've looked at properties that are barely keeping their head above water. I've looked at properties underwater. I've looked at properties that are drowned. I looked at 200 apartments the other day, empty.
Damn.
The guy just called me on the phone. You witnessed it. He just told me, I got this 304-unit building for you. It's 20% occupied.
Yeah.
Oh, and then in Florida, a lot of people got hit by the last storm. Flood coverage is not much if they had flood coverage. So now they're sitting here. I looked at a 16-story building the other day, shut down. Right here, 20 minutes from here. I looked at hotels on the beach, shut down. Why? Because the flood kicked their ass, and now they need all this money pumped back into it. Some of them have been shut down by the city. They got red tags on them. And somebody needs to come in with major capital and put the place back in shape. But in order to do that, you have to buy it right. And the banks have to realize, listen, we screwed up.
So Killif, man, Ben Mala, he said a lot in that diatribe, man. What you think, big dog?
Man, he's right. If you bought the property, you had 3%, and it goes to 6%, and you got a $10 million loan, you SOL. Ain't nothing you could do.
Yeah. That is correct. There's nothing you can do at all, guy. There's nothing. He's right. Right now, Cliff, I'm looking. I'm looking at a couple apartment complexes in Detroit, and what's happening is one guy actually has 2,000 units that he's trying to get rid of. Just get rid of them. During COVID, me and Cliff went to Memphis. We were looking at an apartment complex on the same street. We saw 3 apartment complexes that were 20% occupied. 20%. Am I right, Cliff? Or am I wrong?
Oh no, I mean the standards weren't. Memphis standards. It says Memphis standards, but but empty.
Empty. Cliff, tell them about what you saw on that commercial property. And guys, there's a video on my YouTube page. I'm gonna repost it. You'll see it. You'll see it. We ain't lying. Go ahead, Cliff.
Nah, it's just, just the standards out there are just different. Every area is a little different. Dallas, there's certain standards you have to meet. Like you can't have loose wires. You can't have exposed piping in certain areas. You have to be through a conduit. Not Memphis. You can have exposed wires.
Yeah.
You don't have to have conduit.
Yeah.
That all meets standard.
Yeah, it does. I remember when we got first. Cliff was like, "Why in the world is this right here? Why is the water coming directly down on the condenser like this?" And the guy said, "Oh, this is past inspection." We were like, "What?" Yes, y'all. That's Memphis. Memphis is the worst rent city, I think, in the union. It's worse than Baltimore. It was bad. It's bad. It was bad, y'all. It was me and Cliff were pissed. We were pissed because of what we saw. Right, Cliff, am I wrong?
Oh no, the city is. Man, the bright spot was McDonald's.
That was the bright spot and a half, man. It really was. But we were pretty pissed off. But again, guys, that is what's going on. He's not lying, guys. That's why I said the commercial arena, because it's sexy, because you own an apartment complex. That's a great thing to own. But what they're not talking about is you have a lot of apartment complexes that are 20%, 10% occupied. And those are non-recourse loans, which means non-PG. So in other words, that investor doesn't care. He just walk off. Am I right, Cliff? Am I wrong, don't?
Oh yeah, whenever you have non-recourse. Yeah, I mean it's crazy, and you also got to think the banks right now also have other options, because right now the big lending is going into data centers.
Yes.
So the banks have something to relieve their. If they had to give out money, then maybe they would be fighting it back a little bit more, but they don't need to, because data centers are hot. People need loans, and they'll pay the 7%, 8%.
They will. They will pay it. They will pay it. And right now, a lot of banks are really just starting to say, bump what's going on with the commercial, bump what's going on when it comes to residential. Let's go ahead and just find out these data centers, because that's printing money for that. I mean, that's printing money for them.
Yeah, I was doing some research on it. Some of those data centers are first year 30% return on investment. First year. Some are more. I saw some opportunities that were 50% return on investment first year.
First year ROI, guys, 50%. That is an amazing ROI.
Crazy.
With less headaches. You ain't even no damn tenants. It's machines. That's it. Am I right, Cliff?
Man, it's when I did my research, I was trying to understand who's paying for this, where is it coming from? It's just demand, because what's going to end up happening is everything is going to go AI. Your headphones that you have right now, in the future, probably going to have AI on it. Your microwave, everything. That's going to be chips. Mm-hmm. That's going to need storage. So anyway, it's driving demand right now in the real estate space. If you have an opportunity to do so, they're trying to take advantage of it. So the banks have a relief. Mm-hmm. They have another avenue to still make some money.
They do, and they're making a crap load of money right now. That's why they're not in the hurry to unleash the shadow inventory, because they're making so much money on that side with the data centers, which is kind of making up for what they're losing on the residential and commercial side. Would you agree, Cliff, or you disagree?
Exactly. Yeah, that's their way of making it up, and that's why you probably heard. I don't know if you were paying attention to the Nvidia stock. They beat estimates. The estimates thought that they were going to make $70 billion. They made 90.
What?
Nvidia. The reason why is because a new Nvidia chip has such a high return on investment right now. Like that's how they're getting those 30%, 40% returns, is because right now, if you put those in deployment, so there's that relief. There's a place if you're wondering what's going on with AI, that's what's going on with AI. And that's why Nvidia is keep going up. It's because, Dale, me and you could buy an Nvidia chip today and get a return on investment on it tomorrow.
Yeah.
So everybody wants to buy one.
That's correct, guys. He's right, guys. So again, Ben Mala is correct. There is a correction in the residential and also in the apartment, in the multifamily space. And I think that the biggest correction is in the multifamily space. I'm seeing it. Boots on the ground. I'm seeing it. I mean, Cliff, 2,000 units, man. He's like, man, just take it from me. I'm like, 2,000 units, guys. Yes. Again, that's what's going on, guys. That's what's going on. Now, let's go to our next topic real fast, guys. Real quickly. Our next topic is guess who's back? Guess who's back, Cliff? The 50-year mortgage, baby. It say, hey, we back, baby. You know what I'm talking about? Hey, is this an affordability solution or is it a debt trap? I can kind of probably assume what Cliff is going to think. But it's okay. We're going to dive into it real fast, guys. And we're going to listen to President Trump talk about this as well. Also, then Cliff, we're going to respond from a retail standpoint and also from an investor standpoint. Let's dive into it real quickly, guys, and see what's going on with this thing. Here we go. Let's get to it.
So President Trump just came up with a solution to make housing more affordable, which is to stretch the standard 30-year mortgage to 50 years.
Is that really a good idea?
It's not even a big deal. I mean, you go from 40 to 50 years, and what it means is you pay something less from 30. That some people had a 40, and then now they have a 50. All it means is you pay less per month. You pay it over a longer period of time. It's not like a big factor.
Here's what's crazy. The NAR just released new data that shows the median age of all home buyers is now 59 years old.
Wow.
Which means by the time you pay off your house, you'll be almost 110. Let's hope AI gets us there, because by stretching it to 50 years instead of 30, they're promising that this is gonna make our monthly payments smaller. And the truth is, yes, you will save a couple $100s each month, but the reality is you'll save only about 10% a month, but you'll end up paying almost twice as much in interest, and you'll most likely be staying in debt way past retirement. And that's if you ever pay it off at all. Now, even though that's the case, if you're someone who is a savvy investor and you understand the concept of the time value of money, which I'm going to show you, a 50-year mortgage can actually work out in your favor. And in today's video, I wanted to look at this as objectively as possible and show you what the math says is the real truth.
So Cliff, man, we know the math already. We're smart. We know the math. So Cliff, man, let a player know, man, what you think about this 50-year mortgage. What's going down, baby?
It's not worth it. It's like you said, if you could pay, I don't know, $3,700 versus $4,000 to get it, and your mortgage is 10 years longer, it don't make sense. It don't make sense. It's better to pay $300 now. Yeah, it just to me it don't add up. The math don't make sense to me. Best instead of trying to do this, just get the debt down, get the interest rates down.
So what you're saying is a 50-year mortgage from a retail standpoint is a bad idea.
Oh yeah.
Okay, let's park right there for a second. If the rates remain high, 6.5%, 7%, which means the cost of capital goes up, which means people's payment is most likely doubled or 1.5. Here's my question. Wouldn't this type of solution drive that payment down a little bit for them?
Oh yeah. I mean, if you why stop at 50? Let's do 100. It'll be really cheap. You know what I'm saying? If the concept don't change, let's bring everybody's loan down. Let's make it 100 years.
Yeah,
It's the same thing. You know, the banks will love it.
Oh, well, they let it. Now, guys, in China, they have 99-year mortgages. They do it in China, so don't get twisted. They got it in China, 99-year mortgages. That is real. That's real. So it's now from an investor standpoint. My opinion is, I don't mind 50-year mortgage because it allows me to write off debt more.
That's true.
And it allows for me to generate a higher rate of return on an annual basis. I'm paying less monthly cash flow. If my strategy is to buy and hold, a holder would not at all be opposed with the right strategy to a 50-year mortgage. Man, you agree or disagree?
I mean, if you're trying to go for a cash flow basis, the problem is that you're not building equity quick enough.
I agree with
it's
that.
Going to take you an extra 5 to 10 years to get that equity cushion that you get in, let's say, 8 years now.
Yeah.
Now, so if it takes you 8 years to get a little bit of equity with everything in the future, imagine if it was 16 years to get that same equity.
So an extra 20 years is you're paying. So if you're tripling, if you borrow $100,000, you're paying $300,000 back on a 30-year mortgage. You're basically doing another half of that in interest.
Yeah, probably another probably 500,000, something like that.
That's correct. That's
less.
correct. That's crazy.
Nah, that's
crazy.
Just lower the interest rate. That's the key to everything, man.
But how can they lower the interest rate if they're constantly printing? How can they lower the interest rate?
They can't. What's going to end up happening is the interest rates will come down. I promise you. Know how I know that? Because there is going to be another catastrophe. There's going to be some other, 2008, 1973. There's going to be something that's going to happen where they're going to have to cut interest rates because the market's crashing, and that's going to be the reset.
So you saying the reset? I got you. That's what you're saying the reset is. So what you're saying is we are a pandemic away from the lower rates.
Yeah.
Now, why do you say that?
Because there's no reason to lower the interest rates right now. Right now, we're not paying our debts. The odds of default are going up, so interest rates are going up. And the only reason why to bring it down is if the market's crashing. Oh, okay, now we have a real issue in the market that we can cut rates to solve.
Yeah.
That's what happened during the pandemic. The market started crashing. So what did the Fed do? We cut the interest rates in order to support and get some more money and liquidity in the system to support it. That's what we have to do. We're waiting on that. We're waiting for that big movement. They'll cut interest rates, and that'll be the moment, and then there'll be a refinance boom.
Now, I believe that the cutting of the interest is going to be probably around about the next 3 to 5 years. You agree or disagree?
It's hard to say. It's hard to say from what it is right now. I mean, if we keep printing the money that we're going to, and I think we will. I don't think we're really going to change. Unless there's a catastrophe. That's it. I think beyond that, we're looking at minimum 6% for a while.
I agree. I agree. So 50-year mortgage, depending on your strategy, could be cool. Residential, probably not a good strategy. I mean, unless you get even if you got a mortgage at 20 years old, Cliff, you won't pay that boy back off until you're 70. God dang, that's crazy.
Nah, I think if you really did it like that, what would happen is you would have more sales.
Yeah.
You'd have a lot more sales because it wouldn't make sense to hold on to properties like that. And you'd have more renting because you'd have landlords who are like, cool, give me that 50. And they would own it. The landlords would own it forever. And they would just be refining every 10, 15 years.
And do the same if 50-year mortgage every time. I think what they really want is they really want that type of setup. They want the money to flow. So that's why they're introducing that 50-year mortgage. Because if money's not flowing in a currency-based system, that's when they get stagnant. When they get stagnant, they go inflation. There it is. So it's just it's something else. But again, a 50-year mortgage. Is it a good idea residentially? Now, would you accept a 50-year mortgage on a apartment complex?
Oh, on an apartment? Yeah, all day. Lock that in. If it's cash flowing day one on a 50-year, yeah, lock that in.
Why? Why is an apartment complex different than residential?
Oh, it's a cash flowing asset.
Yeah,
If it's cash flowing, I can lock it in. Yeah, I'll take that cash flow for 50 years and let that cash flow just build. And I get all the write-offs. Yeah, I'll take that.
Yes, sir, man. That's what it is, guys. So 50-year mortgage, guys. If you're a residential buyer, I don't think it's a good idea at all. No. If you're an investor in residential, I don't think it's a good idea at all. I would say it depends on your strategy. Okay, if you don't mind I don't mind a 50-year mortgage on a residential property investment-wise because I get the benefit of writing off taxes, having no paper losses. I like that. That's just me. Apartment complexes, I am definitely for a 50-year mortgage all day long. Commercial buildings, I am definitely in favor of 50-year mortgages all day long.
Yeah, because they don't really. Because normally it's 5-10 years is normal on a commercial asset. So you get 50, you take that
all day long, guys. So again, it depends on your asset and your strategy. Real simple. Now, guys, let's go to our last topic real quickly, guys. All right. Our last topic is let me get this guy off the screen real fast. And go follow this guy, man. This is I don't know this guy's name, but he has some great commentary. He really does, Cliff. Now let's go to our last topic real fast, man, and then we'll be done. Elon Musk, your mans and them. Oh, my bad. I'm sorry. This is our Protect the Bag series, guys. My fault. Here's a little bit of thing.
Network and hustle.
Now, guys, this is Elon Musk. He has began his own bank called X, but it's a digital bank. Now, I've been going really hard in the paint with my live stream, talking about how the dollar is going digital. It's going digital. And because you see that what happened when it came to the Genius Act and the Clarity Act. If the federal government is going digital with the CBDC, central bank and digital currency, and you have the richest man in the world doing a digital bank, that's what you call a clue. Clue. So, Cliff, man, let's look at some video about this guy and see what he's offering that is contrary to what the legacy banks are actually offering. This right here kind of shocked me a little bit. I just said, "Oh, really?" It's pretty slick, man. I got to give it to him. But let's see what's going on. Here we go. Let's get to it.
Created a credit card that'll probably wipe out Visa, MasterCard, and American Express. Look at this. This is insane. Formerly Twitter, X will give you 6% APY on your deposits. That's 50% more than if you invest in treasury bills and get yield from the US government, and like 1,000 times more than you'd get just leaving your money in a bank. 6% is nutty. You also get the same insurance you get with a bank account, as well as 3% cash back on all purchases. They also have some sweet features for creators. The point is, Elon isn't playing here with X Money, and he's really trying to create the new financial super app. Do you think that you'd use this X Money card over your current Visa?
So, Cliff, what do you think about that so far? I have another video that goes a little bit deeper, right? He talks about how the banks are kind of scared. You know what? I'm going to show them real fast, Cliff, and then we can respond to this. Here's another video, guys. We're going a little bit deeper on what Elon is doing. A little bit deeper so you get a better context. Here we go. Let's get into it.
And look, every single bank in America is staring down something genuinely terrifying right now. And I'm not talking about another housing crisis or some crypto bro meltdown, though God knows we've had enough of those. I'm talking about a fundamental shift in where Americans keep their money. Trillions of dollars just leaving, walking out the door of traditional banks like they just realized there's a Costco sample station across the street. The catalyst here isn't the Strait of Hormuz, rate cuts, or pumped up AI stocks. It's Elon Musk. Now, I know what you might be thinking. Of course it is. That man is either saving civilization or destroying it, depending on which tweet you read. But this isn't about Tesla share buybacks. It's not about the SpaceX IPO. It's not even about whatever the hell is happening with his robots building robots. No, this is about something he's been working on in the background that nobody is paying attention to. You see, your bank is paying you almost nothing. The average is 0.38% interest on a savings account right now. And the richest man on earth just noticed. So while the internet has been immersed in everything Elon the last few weeks, he quietly flipped a switch and launched a bank. 6% on your savings, roughly 15 times what the big bank down the street pays you, sitting inside an app 600 million people already have open on their phone. Oh, and there's more. 3% cash back on purchases, FDIC insured up to $250,000. He's basically beating banks at their own game while reposting memes 15 times a day. And he's not being shy about the ambition. In his own words, he wants X money to be, and I quote, the place where all the money is, the central source of all monetary transactions.
Now, Cliff, he goes a little bit deeper, but man, real fast, brother. What you think, bro, about this whole play by Elon? What you think about it, big dog?
I mean, he's raising the bar. 6% is crazy. That's crazy. And now it does say up to 6%. So that's cool. That's the best thing I've ever seen is 6% with 3% cash back. For most people, it's not that big a deal. For a lot of people, unless you have a lot of cash, you got $1 million. You're making $60K a year.
Yeah.
Just leaving it in the bank account.
Yeah.
That's wild.
Yeah.
That's you can't beat that. So I mean, and then you get 3% cash back. So if your lifestyle is spending, let's say, $300,000 a year, you're getting $10,000 back a year. That's crazy.
Crazy, Cliff. Now the question is, how can he do this? How can you do it?
Man, I'm guessing what they're trying to do is bonds. They're probably stronger in the bond market, but you already know. What's he doing?
Okay, let me break down, guys, legacy banks versus digital banks. A legacy bank, guys, is, as you know, the Bank of America, Wells Fargo. Those are what they call legacy banks. They have a branch on each corner. Now, each branch on each corner is cost capital for them to run. You have property taxes. You have to pay the utilities. You got to pay for the employee salaries, insurance on these employees. You have to get all the office equipment and other things as well. All this stuff goes into a branch. So you're looking at, let's just say, for instance, hypothetically, their operating budget is 30%. 30% just to have branches, right? So off the rip, they lose 30% of that, right? Digital banks are different. Digital banks it's like SoFi, Chime, PayPal, Stripe. Those are what they call digital banks. Guess what the operating budget is, Cliff?
Oh, nothing.
0. So off the rip, they save 30%. So how can they pay 6%? They got to pay out 30%. So they're making so much money, and they give them better rates. They give them better terms because they have a less amount of responsibility to run. And here's a brilliant part, is they understand that the legacy banks actually have a big footprint in the marketplace via the branches, right? So how can a digital bank compete with a legacy bank to be able to grow their footprint without having to implant branches? Simple. They partner with people like you and I, and we partner with them, and they share the profits with you and I. That's how they do it.
And free ATM, no ATM fees.
Free,
yeah.
Cliff.
It's interesting. Everybody's going. If you do 6%, that's going to be every business is immediately going to be doing that. Man, that's. And then you got to think too is he's not going to stop here.
No,
I'm guessing he's going to end up adding stocks, bonds, some other financial instruments to it, crypto.
The blueprint is SoFi. SoFi is a full-fledged digital bank. Cliff, they start off with just refinancing student loans.
Right, true. Yep.
Now they do student loans, mortgages, life insurance, car insurance, deposits, business loans, still student loans, house investment. And I'm like, God dang. And they're all digital.
Yeah.
All digital. They're the blueprint. So you're correct. It's going to be crazy. And they're paying 4%. 4% for you man sitting there. Just 4%. Theirs is attached to an actual bond. It is.
Right. Man.
That's something, ain't it, Cliff?
It's crazy. It's I mean, those are the best numbers. He definitely got people attracted to it. So,
you can make in-app transfers to people, real money, send wires, deposit your whole check into the checking account. It's all there. It's all there. Yeah. This is called banking as a service. That's how Elon said, I want all the money. So he wants to do his own thing. Other banks are saying, hey, we'll partner with you, Cliff and Liddell, and you guys can actually have your own digital bank yourself with our backing, right? Which is fine.
Right.
And then what happens is, now that's their branch. Their branch is you and I. And it just so happens we get paid each time there's a swipe of someone's card. We get a share of the credit card interest, business loan interest, car interest, car insurance payments. It's all there, Cliff. That's how they're going to establish their footprint. It's what they've been doing the whole time. I mean, it costs them nothing. It costs them nothing to do it. Am I right? Am I wrong?
Nah, digital is the way to go. I mean, it's a monster. Especially with AI going in now. So it's a crazy future that we're going into with him competing. The richest man in the world just formed his own bank.
He did, guys.
I don't know where it's going from here.
His own bank, guys. But here's the newsflash, guys. You can do the exact same thing that he just did. Literally the exact same thing. So he's done. All he did was just partner with Riverside Bank in North Carolina. That's all he did. That's all he's done. You can do the exact same thing. You can, yes. And I'll go into that in another live. If you want to know more information about that, just let me know. It's all good. But yeah, Cliff, that man started his own bank, bruh. Own bank. That's crazy town, man. Richest man in the world. Richest man in the world, man. But guys, that's all I have for today. Cliff, you want to say anything, man, before we get up your dog?
Nah, man, you already know, man. You one deal away. Matter of fact, they got deals. I was gonna see it to you because I saw you get your nephew.
Yeah.
Were y'all going to Jackson?
Yeah. Yes, we do. Yeah.
Man, they still got deals out there, man. So
they do. And what we're gonna do is just to help him out. Is to he wants to get really heavy into real estate. Somehow I'll help him out, and we can buy something cheap. Walk through it together. And of course he gets to travel up there, and the whole ordeal here. Because we can't find anything here like that here, unless you have to go to Oak Cliff in the hood, and we.
Oak Cliff blowing up.
It is.
It ain't cheap no more.
It is. Man, Cliff, I was driving by Fair Park. Bro.
Fair Park is completely renovated.
I was like, what is this?
Yeah.
I mean, it has been gentrified for real, bro.
Mm-hmm.
Golly. I just said, and they were going to put AT&T Stadium right there.
Oh, okay.
They were going to do that, but Laura Miller was the one who actually killed the deal. She killed the deal. But yeah, that's what AT&T Stadium was going to be. It was what you just saw that clip was going to be 10x. 10x. It would have been off the chain, but yeah, that's all I have for today, man, Cliff. But yeah, man.
All right, man.
We guys, man, we got to go. God bless you guys. We always say, man, you one deal away. And how about them Cowboys? Okay, them Saints. Man, we be praying for you, man.
Who that?
Oh, yeah, who that? Yeah, who that?
Nah.
Who that?
Matter of
Who
fact,
that
I think we play y'all on a Sunday.
You sure do though. Is it Sunday or is it today?
Is it today?
Is it today?
I ain't even check.
Let's check if it's today. If it's today, baby, it's gonna be on and popping. I'm gonna get some wings. So. Is it today?
What's the game?
Let's see.
Preseason game.
To the
Oh,
Cowboy
shoot, it's
app.
today.
It's today, baby.
7 o'clock.
Yes, sir.
All right, it's all good. Whoop that ass today versus Sunday. It's all good.
Amen.
It's all good.
Everybody can dream sometimes, man. Everybody can dream sometimes. Even you, Cliff. You can dream sometimes.
hey.
So,
keep up that optimism. I want to see end of the year. I want to hear that when y'all make the playoffs again, and then you throw 3 interceptions in the first. It's all good.
Say, you know what? Here is the problem I have with these fair weather fans, like Cliff. Unless we win a Super Bowl, it's a failure. Every time. That's a fact.
You said the standard.
I'm not. I'm like, you know what? Let me wait and see. Every year, I will say it. Our fans are the most delusional fans on the planet.
Okay, good. Yeah.
You know, for the last 30 years, we've been saying we're going to the Super Bowl. Y'all ain't happen. Shut up. Let's get to the playoffs and win a goddamn game.
Yeah, there you go. That's right. Just do that first.
Come on, man. Stop all this. We going to the... No, we not. Stop.
Yeah, the Cowboys are a solid team. I'll give you that. They are a solid team.
Yes, we are.
They can have an upside. They just never attain it. That's really... But they solid. I'm not going to get that away. Dak is a top 15 quarterback.
15? Top
15. Top 15.
Hold on. What 15 was... 14 is better than Dak. I gotta hear it. I gotta hear this.
Yeah. Dak probably about top 15.
15, like, damn. The disrespect. The disrespect for Dak Dakota Prescott. I gotta say his whole name, Dakota Prescott. Come on, man.
You could do the seasons. I like playoffs. And Dak gets a lot of garbage yards. I never seen somebody get so many yards in a loss. He gets a lot of yards in a loss.
See, I will admit that we are the most delusional fans on the planet. We are. But at the exact same time, y'all are the most dishonest haters on the planet. Y'all are. Because it's like, y'all in the Super Bowl, it's a failure. But y'all, we got to play. We got playoffs, though. That's playoffs, though. But you didn't win that. But we got playoffs, though. I'm like, it was success. Like, wait a minute. How is it that we got to the NFC Championship game, hypothetical, and we lose? Failure. Y'all suck. But y'all lose in the first round. Good year. We're gonna get them next year.
Wait, I'll say this: the only reason why we say that is because it's a lot of the other. Let's be honest, in the NFL today, most of the quarterbacks they're not good. Most quarterbacks are not good, and so we expect more from Dak. I think that's what it is. It's not like Dak is okay and we're like, we just hating on him. No, Dak has the fundamentals to be great. He's just not great. That's the problem. We're expecting him to excel. He always tends to come up short.
See what I'm talking about? You see what I'm talking about? That's an unfair
Dak Prescott
comparison.
is Charles Barkley. That's what I'm trying to say. Great player.
Wow.
Great player.
So I got to ask this question: is Lamar Jackson a Charles Barkley?
Yeah, I'd say so.
Oh, can you consistent? You consistent? Okay.
But I would pick Lamar over Dak though, all day.
I would too. I would. Yes, I would. Lamar is he man.
Yeah, he's special.
Man,
he's special.
He's something. Oh, lastly, did you hear, man? You hear this mess, bro? There is a potential proposed trade for Kyrie to Miami Heat, man, for Nikola Jokic, somebody else, and like 3 picks. And I'm like, what are we doing?
Yeah.
What the hell is going on?
They're getting young. That's really what it is. They trying to go young because we got a 19-year-old who's all world. Let's be honest. Coop, you're not gonna get another Coop. That's not gonna walk through the door.
It's not.
So, and Kyrie's 34 coming off an ACL.
But you want to get 1 year with the dude, man? 1 year with the dude, man?
Look at this ownership. They traded Luka. I don't trust nothing. Who knows what they gonna do?
Man,
that's the only reason why I think they won't do it. It's because of that Luka trade.
You know what I think they're trying to do? They're trying to get younger because I believe in the next 2 years they're going after Luka again.
I can't.
It was such a bad trade, man. I think Luka's not happy out there. He ain't happy, man. He all trimmed now.
He not happy because about what happened, his whole situation.
Oh yeah,
because he moved to California, and as soon as they got to California, it all went down.
So did, man. Get out of Cal. Get out. Leave. Go. But all right, y'all, man. Hey, man, Cliff, if I FaceTime you, Doc, doing the Cowboy game, don't avoid the phone call.
It's backups today, though. It's backups.
Yeah,
we're not playing our starters. So
yeah, we're not. So it ain't no real game. Do we play y'all in the regular season?
Nah.
Y'all know better. Y'all know better. Y'all know better. We play.
That's why I think Dak Prescott and Jared Goff are equal. I put them as equal.
And you know what? That's a fair comparison. That's a fair until Dak wins something. Yeah, that's about right.
Yeah, he's a solid player. Like I said, I would take him. I'd take him. I'm not gonna say that. I'm not trying to put him down. It's just Dak. He's just missing something. I don't know what it is. It's just there's times he elevates. You're like, dang, he might be the best player in the league. And then there's other times where you're just like,
really?
I think inconsistency is Dak's problem.
Yeah, I agree.
He has the potential. It's just inconsistent. So.
Yeah. Well, guys, gotta go. I'm actually gonna run some errands, and then I'm probably gonna make some lobster tonight. Maybe some lobster or something like that. Something like that. I'm gonna do it tonight. I'm gonna do it nice, man. I'll be in Starkville, guys, on Sunday with my baby girl. No, I'm sorry, Stillwater. With my baby girl. She want to see Pops. So I'm gonna go see her. So it's a 4-hour drive. So I'm gonna be listening to some books while I'm driving. But it's gonna be a pretty good thing. So it's gonna be good. I may do a live stream while I'm there. You can say hi to her. All right, y'all. Well, all right, Cliff, man. Have a good weekend, brother. All right, y'all. Holla at y'all, man. Peace. What's good, guys? It's your partner Dale here, man. Hey, I always say that when it comes to real estate, I think this is the best time. The next 3 to 5 years is the best time, in my opinion, to begin to invest in real estate. Whether you are a seasoned investor or a novice investor, this is the best time, in my opinion, to invest in real estate. Now, why would I say that? It's very simple. Whenever there is some stagnation within the real estate industry, that's the best time to get deals, right? Deals are what attract the capital, right? A good deal will always attract good capital. Now, what's a good deal? Well, I like buying distressed properties below wholesale. The skill to buying right is learning how to locate distressed properties in your city, county, or state. Now, the good thing about it is we are giving away a free ebook called Distressed Property Investing. We talk about different ways of locating distressed properties in your city, county, state, what to look for, who to call, things of that nature. It is free. Once you master this type of skill of locating distressed properties, you'll never be broke ever again, because good deals attract the right capital. All right, guys. So to get the free ebook, click on the link below, scan on the QR code here on the screen, or you can DM us the word real estate and my team will get you out this free ebook. Again, it's completely free. Just want to get you this information so you can begin to get the bag while buying real estate. Stay blessed and holla at your butt.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more buy and hold. Okay, so you're a wholesale first.
Okay, because I was broke. I had no credit, I had no money. So I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming. Okay. It didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah.
Just a little bit of a down tick, it's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09, that's why I made a lion's share of my money.
Wow,
People
okay.
were actually running from the cows. I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties. I take home money when I actually acquire it every single time.
Okay, you need to break that down just a little bit.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.
Right now, someone in your phone contacts is buying a coffee. Someone else just got a notification that their monthly subscription renewed. The average person taps their card more than 30 times a month and auto-pays nearly a dozen subscriptions. These are regular habits that lead to daily and monthly spending. But what if every single one of those microtransactions paid you? Introducing Dingo Blue, a powerful financial technology platform built for the way people actually live today. Powered by the ACN direct sales infrastructure, Dingo Blue gives your network a frictionless mobile account. 16.6 trillion. That's how much money is sitting in checking and savings accounts across the United States right now. Now, imagine getting paid when your customers simply do what they're already doing every day. When they keep a balance in their savings and checking accounts, you earn every single month a small percentage of what is in those accounts. When they tap their card for groceries, you earn. When they fill up their tank, pay their bills, grab a coffee, book a trip, or shop online, you earn. Every swipe, every purchase, every month. Every transaction creates another powerful opportunity to earn income through everyday purchases people are already making. Bills, gas, online checkouts, every swipe creates another opportunity. Dingo Blue aggregates those micro percentages, building a compounding residual pipeline directly to you. You acquire the customer once, you monetize their lifestyle indefinitely. No legacy fees, total transparency. Banking services are provided securely by our licensed FDIC-insured partner bank, giving your network institutional-grade protection. Stop funding someone else's success. Start creating your own. Tap into your pre-approved marketing toolkit, connect with your network, and launch your Dingo Blue engine now.
To learn more about this banking-as-a-service digital banking business model and to see how it can potentially benefit you financially to build wealth, click on the link below, scan the QR code, or DM me the word bank. I'll send you the details. Stay blessed and holla at your partner.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks.